A UK stock that's just about still a UK stock, I think. Ashtead hasn't gone to the US yet, but is making its way across.
Yes, I think it's next quarter that this should be completed. Ashtead Group is essentially an international equipment rental company, primarily in North America, where it's known as Sunbelt Rentals, but also a little bit in the UK. It provides a wide range of tools, equipment, services for end markets, but mostly kind of the construction-y kind of industry. And yes, through Sunbelt Rentals, they rent out this wide variety of equipment. And I got a list for you because it's maybe a little bit inconspicuous to people who don't rent from these kind of places. But you're looking at like hand tools to heavy machinery like excavators on forklifts, scissor lifts, which are those lifts that sometimes you see window cleaners in that kind of have the scissor arms like that extend to get you higher up. Boom lifts, which are the same kind of things, just on a boom crane arm. Things for working at height, essentially, but also power generation, generators, heaters, air conditioners, that kind of thing. But also they have scaffolding, things for traffic management, equipment for sort of film and TV industry when they need to shut down roads and things like that. That's who you would go to. Temporary offices, fencing to keep your site safe, and other kind of on-site necessities as well. So that's kind of the bulk of what they offer. The results that we just had, Steve, were their full year results. A kind of mixed performance is what I would describe it as. Record rental revenue, record adjusted EBITDA, but actually a decrease in total revenue and PBT. So they talked about their new strategy, Steve, which used to be Sunbelt 3.0, and I bet you couldn't guess what they've called it. That's right, Sunbelt 4.0. This is focused on basically investing in themselves, getting market share gains from that, and also improving their operational efficiency. So it'll be interesting to see where they go from here forwards. But revenue decreased by about 1%. It was 10.859 million. These are in dollars. It's now 10.792 million, and they've started to they used equipment as essentially when it gets to the end of the shelf life, they tend to sell it off, and obviously then renew it. They've actually had lower sales of this used equipment because rental revenue actually increased by about 4%. It was 9.63 million. 9.63 billion, sorry, and it's up to 9.98 billion, which meant adjusted EBITDA rose by about 3%, 4.893 billion to 5.022 billion, but operating profit decreased. And again, this is impacted by about 142 million lower gains on disposal than the previous year. Adjusted PBT also decreased 5%, Steve, so they didn't adjust it enough. It was only 2.128 billion, and adjusted earnings per share decreased 4% with it as well. 369.5 cents was 386.5 cents. Free cash flow was significantly increased. It was about 1.8 billion, just under that. And the year before it was only 216 million, so pretty hefty jump in free cash flow there. Net debt, Steve, to adjusted EBITDA, that's what they give you. It's 1.6 times. It was 1.7 times. So that is slightly improving. And a final dividend, Steve, of 72 cents, which takes you to 108 cents for the full year, which is slightly up on the 105 cents from the previous year. In terms of operational highlights, they were keen to point out full year rental revenue was up. Adjusted EBITDA was also up. Near record free cash flow of 1.8 billion was achieved. And also that they spent about 2.4 billion reinvested back into the business. About 886 million also passed to shareholders through dividends and through share buybacks. So, yeah, they evidently see value in themselves, and yeah, it's interesting to see the sort of capital renewal in action there. About 42,000 new customers added in the year, Steve. Cross-selling effectiveness, they said, was expanded. About 50% of customers now rent from 3 or more of their specialty lines. They added about 4 during Sunbelt 3.0, they added about 401 new locations, which they said brought in about 1.9 billion of additional revenue, about 900 million in EBITDA. They've already added 61 locations in this first year of Sunbelt 4.0, so that seems to be going okay. Primary listing of the US will be sort of back end of this year to the first quarter of the calendar year of 2026, and yes, that's very much in process now as a move over. And Steve and I spoke about this either last week or the week previously. It's a company that gets the vast majority of its revenue from America, so it really needs to be in America. It makes sense for this company to be an American company. I don't think they'll go get a massively increased multiple over there, though, Steve, because they already trade on a fairly hefty one. So net debt, this is probably the figure that'll scare off most people. 10.331 billion. It was 10.655 billion, so it is coming down a little bit. Average age of the rental fleet is about 49 months, and it was 45 months the year before as well. So it's getting a little bit older. They have actually managed to improve their receivable days though. It was 50 days. That's now down to 47 days. So there is some positivity there. The outlook was mixed, I would say, Steve. They said they're going to be flat to about 4% growth. They reckon capex would be between about 1.8 billion and 2.2 billion, and they should generate between 2 and 2.3 billion in free cash flow, which the upper end of that is their free cash flow record. So I thought this is an okay report, Steve. It's kind of sad to see the revenue decreasing, but obviously that's not due to issues with their core business. I guess the rental revenue, the issues with their disposals. It would be interesting to see how it does when it goes over into America. I'm not sure the Americans are going to love this company in its current state. I think they're going to want to see a little bit more of it, Steve. What do you think?
Maybe that might be right. I mean, the day they announced, I don't know if you remember this or whether we talked about it before, the day they announced they were moving to the States, their stock went down quite a bit. But not because of that. Well, probably not because of that. It's always hard to tell when several things happen in the same day. But they also announced a profits warning. It was the end of last year. And that's probably a lot more to do with the reason why the stock went down than they were moving to the US. And I'm always unsure as to... I mean, if you're being very cynical about this, which we sometimes are on this show, you might want to think that, well, perhaps they said we'll move to the States the way that Elon Musk says we'll split the stock or something like that. Announce something that doesn't really matter to your business very much to try and distract from the fact that something's not gone the way it was meant to go along the way. But in fairness to Ashtead, we have said, look, there are genuinely good reasons why this ought to be listed in the US. It makes sense for them to be listed in the US. They're basically a US company. It makes nearly no sense for them to be listed over in the UK. You can think that's true and still think the timing is quite curious. They didn't become a US company last year, particularly. So the fact they decided, well, actually, we'll choose the bit where things aren't going terribly well, and we're going to issue a profits warning and say, by the way, though, we're taking this to the States, so maybe that will help prop this up. Make of that what you will, but it didn't immediately get them the obvious boost that, sort of 3 years ago, 4 years ago, Tesla was getting just by deciding to split its stock, which also makes absolutely no difference to anything. So when I look at this, I'm not massively surprised that either that their used equipment sales are a bit weak this year, or that the outlook for them isn't kind of incredible. When I look across at some of the other areas, which are not the same, but in the kind of ag machinery area, inventories are getting quite high, commodities prices or crop prices are getting quite low. Construction output has been not terrific, I think, in the US. So I sort of think this might be a kind of cyclically slightly slow bit for them. And they trade at around 16, 17 times earnings, but there is good growth kind of coming through if you look kind of for a bit more of a sweep over these things. I'm looking at the kind of what they consider to be their inventory levels, which I assume kind of corresponds to their stuff we have available to lease out and so on, and it's growing pretty nicely over the last decade and fairly steadily. So gradually they get stuff in, they lease it out, they try and sell it at the end, and they use the proceeds to buy a bit more stuff, which they gradually add in and lease out and so on and so forth. And so far, they've found a good way of making that model keep moving forward. The downside that people complain about on it quite a lot is that free cash flows are quite low, but they don't seem to be at the moment. I mean, capex is not crazy in this kind of organization. It's not trivial, but there's more than 50% of sort of net income becoming free cash flow here in the last year or so. That's kind of towards the more impressive end, and free cash flow can be quite lumpy. Looking at this as it comes in various different ways and shapes and forms, but they're at an okay multiple. I'm not sure they're at a kind of crazy one. It depends on where you think their kind of trough level earnings are here a bit, Steve. I think I'm probably less interested in this than I am in underwater Ashtead, which is the stock we've talked a bit more about, actually, kind of smaller Ashtead of the two. But I'm guessing you're not particularly a buyer either at this point.
No, and the reason I'm not, Steve, is because I would sellotape the debt, the net debt on top of the market cap to basically move that PE ratio essentially 50% higher. So the market cap's about 19 billion, with about 10 billion of debt on you. You're looking at essentially 50% more on there. So you're really looking at a PE of in the 25s, probably towards the 26. And when you consider an American company of a similar kind of scale, you'd be looking at United Rentals. They're about a 45 billion, 45.5 billion company, and they've got about 11 billion in long-term debt as well. They're trading at a PE ratio of 18. So if Ashtead's in the 17s, United Rentals is in the 18. But obviously, when you sellotape that debt back onto the top of it, it doesn't move the multiple as much. So I would argue that Ashtead is actually trading a little bit richer in the UK than what something like United Rentals is. So that's probably my sort of primary reason I'm not massively interested in it. I think it's a very good company, Steve, and I think the opportunity to buy it was probably sort of 2010-ish when it was about 100 it's about 100p. That would be a 44 bagger for you right now, Steve. I think it's in a bit of a crossroads, and it would be it's probably one to maybe watch, but probably from afar.
Interesting. I mean, I was sort of thinking a similar. I did flag the net debt thing that you pointed out when you said it round the first time on this, and thought that's another 50% or so. But then when I got round to trying to calculate the attempted adjusted yield, if we call it that, or something, then I guess we kind of I sort of found myself thinking more along the lines of adjusting the numerator rather than the denominator here, I guess. Sorry, other way around. Denominator rather than numerator. I was trying to work out how earnings convert to cash flows and missed the point that price is only 2/3 of the equation here. I'm looking at their chart, and you say that might well have been the time to buy them. The other time, I guess, was your chance during the pandemic when things went slow and rental demand went off a bit, and so did Ashtead's shares, kind of unsurprisingly, because a lot of companies did in that situation. And the reason I mentioned that one is that I do know of people who did buy it then. I don't know anyone who bought it kind of way back there, but people who said, yeah, cyclical stock, cyclical business. This is an unusually big cycle down in the pandemic. But you would expect that things will look much uglier for this company than they will for a bunch of others, even though when things turn around, this will then catch more momentum than some other ones will. So maybe sort of 2019-20 was your other potential opportunity, I guess, to try and get this at 2/3 of its current price or something like that, which might make it a bit more attractive. You can then knock off your net debt worries, perhaps. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.